All right, let's dive into the Q4 2025 earnings for Star Bancorp, that's ticker FSBC. The bank put up a really stellar quarter, the market definitely noticed, and management gave us a pretty clear roadmap for what's next. So let's break it all down and see what it means for the stock.
So, right off the bat, the market's reaction was pretty telling. The stock closed up almost 1.5%. And get this, it did that on volume nearly 70% higher than its recent average. So, what on earth was getting investors so excited?
Well, it all started with a really solid headline beat. The bank delivered 83 cents in earnings per share, which, just blew past Wall Street's expectation of around 77 cents. A beat like that really set a positive, bullish tone for the entire earnings call.
But this wasn't just about a single good quarter. These results were the cherry on top of what management kept calling an outstanding year. And it really hammered home the core idea for anyone invested in FSBC. This is what a regional bank compounder looks like in action.
What's so interesting about this call is just how consistent the message was. I mean, every single data point, every comment from the executives, it all pointed back to this one central theme: disciplined, organic, relationship-driven growth. Let's actually unpack what that looks like on the ground.
Okay, first things first, let's talk top line. The bank's growth engine was, by any measure, absolutely firing on all cylinders. And this wasn't some financial engineering, it was just fundamental execution in their core business, making loans and bringing in deposits.
Just look at the asset side of their balance sheet. Loans held for investment, that's their core loan book. It grew by a super healthy 15.3% year over year. I mean, that is the fuel that's going to power their income for a long time.
And here's the best part. That growth was funded responsibly. Total deposits grew even faster, up a whopping 18% from the year before. Having a strong organic funding base like that is what really separates the high-quality banks from, well, everyone else.
And hey, you don't have to take my word for it. The CEO, James Beck, he didn't mince words at all. He framed the whole year in these really clear, confident terms, anchoring the whole story on the exceptional growth the bank delivered.
So the big question is, how'd they pull it off? Well, it wasn't magic. It was a really clear-headed strategy. They pushed their physical footprint into the super competitive Bay Area. They beefed up specialized areas like agribusiness. They went out and hired 10 seasoned bankers. And, this is key, they actively improved their funding quality by swapping out less stable wholesale funds for core, sticky relationship deposits.
But look, growth is only half the story, right? Profitable, high-quality growth is what really creates value for shareholders. And on that front, Star totally delivered, showing off some impressive profitability and just pristine credit quality.
Just take a look at these key metrics from the fourth quarter. Their net interest margin, or NIM, expanded to 3.66%. That is a very strong number. And that strength flowed right down to the bottom line, giving them a return on average assets of 1.5% and a return on equity of nearly 16%. These are absolutely top-tier numbers.
Now, what about the risk? What about the loans going bad? Okay, here's the real kicker. Non-performing loans stood at a mere 8 basis points. That's just 0.08% of their total loans. In a world where everyone is worried about credit, a number that clean is just wow. It really speaks volumes about their disciplined underwriting.
And if you need any more proof, management put their money where their mouth is. They announced a 25% dividend increase. I mean, come on, a big dividend hike like that is one of the clearest signals a management team can possibly send about how confident they are in their future earnings.
Okay, so the past looks fantastic, we get it, but the market is always looking forward, right? So the guidance in the analyst Q&A session gave us a really clear picture of what the road ahead looks like for 2026.
So for 2026, management is basically signaling a bit of a cool down. They're guiding for growth to moderate to a still very strong 10% target for both loans and deposits. They were also upfront that competition is putting a squeeze on loan spreads, and they plan to keep investing in the business to keep that growth coming. And this, of course, led to the #1 question from the analysts. What about capital? Management was super clear on this. At a 10% growth rate, they can fund everything themselves right out of their earnings. But, and this is a big but, if growth were to suddenly reaccelerate back to that crazy 15 to 20% range, well, a capital raise would probably be on the table in a couple of years. And that's a really key trade-off you got to watch. All right, we've picked apart the quarter, we've looked at the outlook, now it is time for the main event, our verdict on the stock, looking ahead to the next call.
So when you put everything together, you've got the strong execution, you've got the moderating growth, and you look at the current valuation. What is the right call on this stock from here?
Our rating is market perform. And look, let's be clear, that is not a knock on this company at all. It's really just a reflection of the current reality of the situation.
And here's why. First, the secret's out. Everybody knows 5 Star is a great bank, and that excellence is already baked into its premium stock price. Second, that explosive 15 to 18% growth we saw, well, that's now guided to slow down to a more normal 10%. And finally, that capital question we just talked about. It kind of creates this medium-term overhang if they happen to surprise us with faster growth.
So, given that view, how might you think about this? Here's one potential trade idea that kind of reflects this whole fairly valued thesis.
The idea here is what's called a relative value pairs trade. You can think about shorting 5 Star Bancorp while at the same time going long a broad regional bank ETF, something like KRE. The logic is pretty simple. Over the past year, FSBC has crushed the rest of the sector by more than 15 percentage points. So as its growth rate starts to look a little more like its peers, its valuation might start to look more like its peers too. This trade is basically a bet on that convergence happening.
And of course, we have to be absolutely 100% clear, this is not financial advice. This is for informational and educational purposes only. Please do your own homework.
So, to wrap it all up, 5 Star Bancorp had a fantastic year, no doubt about it. But that success is now pretty much priced into the stock, especially with growth set to cool off a bit. And that right there is the key takeaway from this earnings breakdown. Thanks for tuning in.